Hey guys, I hope you're doing okay. I'm Jordan, the newbie investor, and today we are looking at the Schwab US Dividend Equity ETF, ticker symbol SCHD. If you're a dividend investor, chances are you know about SCHD. It's a staple in a lot of dividend portfolios. Everyone keeps talking about it, and there's a good reason why. SCHD is a passive ETF that tracks the Dow Jones US Dividend 100 Index. What does that mean? It means SCHD buys the top 100 companies selected based on fundamentals plus dividend growth and quality. The basic requirements include a minimum of 10 consecutive years of dividend payments, plus a market cap of at least $500 million and a minimum daily trading volume. After that, stocks are judged on free cash flow to total debt, return on equity, the dividend yield, and the 5-year dividend growth rate. There's a bit more that goes into it, but long story short, SCHD tries to buy the best dividend growth stocks. Even better, it does it for a tiny fee. SCHD's total expense ratio is just 0.06%. That's been a winning formula, until now. Why? Why has this darling of dividend investors started underperforming? Since the start of the year, the total return of SCHD is negative 1.07%, while the S&P 500 is up 16.96%. If we zoom out, things look a bit better, but SCHD is still lagging behind the S&P. Why is that? A couple of reasons. First of all, SCHD is a lot more focused on cyclical sectors than the S&P. SCHD has a much higher exposure to industrials, financials, and energy than the S&P 500. And these sectors tend to do worse when the economy is struggling. We have all seen how the economy has done over the last year. We have above average inflation, higher interest rates, slower economic growth, and general wariness about the economy. These inevitably lead to reduced spending by both companies and consumers. People start saving more, they become more cautious. This in turn affects company sales and profits. All businesses are affected by this, obviously, but some sectors struggle more than others. People are less likely to skip on food than they are to postpone buying a new laptop or a car. I'm oversimplifying a bit, but that's basically the main reason why cyclicals tend to underperform in times like these. The sector difference is also related to the other reason why SCHD is lagging behind S&P. S&P owns a lot more tech. Apple, Microsoft, Amazon, Nvidia, Google, Meta. These are the top 6 holdings in the S&P 500 and make up almost 26% of the index fund. Meanwhile, SCHD does not own any of them. These 6 stocks alone have seen a massive boom this year, and that's mainly because of the AI hype. This shows us a very important drawback of SCHD. The ETF has little exposure to new, up-and-coming companies and sectors. There is also a trend towards companies not paying dividends and instead returning cash to shareholders via share buybacks. These don't fit SCHD's criteria and are not included in the ETF. This isn't necessarily a bad thing, but if you are a new investor looking at SCHD, then you should be aware of that. SCHD fits perfectly the investor who prefers passive income. However, if you are looking for capital gains, SCHD may not be the ETF for you. The final reason why I think SCHD is underperforming the S&P right now is interest rates. SCHD has a dividend yield of 3.55%. Compare that to the US Treasury bills that give you anywhere from 5.4% to 5.6%. Even longer US notes and bills give up between 4.3% and more. With interest rates this high, income investors could prefer buying them over SCHD. The benefit there is a higher guaranteed rate with no risk of capital loss. This factor alone could be driving a lot of money out of dividend stocks and ETFs and causing their price to go down. The silver lining here is that this gives dividend investors the chance to buy SCHD at a lower price point. Plus, SCHD can actually give you capital gains too, which is why I think income investors will flock back to dividend stocks and ETFs if interest rates go down. These 3 reasons are not exhaustive. There's loads more that goes into pricing SCHD, but they explain most of the ETF's recent price performance. Does this mean SCHD is a bad choice right now? Absolutely not, but it does depend on your investment goals. If you want to get a dividend snowball, then by all means keep buying. If you are after capital gains though, SCHD will most likely lag behind the S&P 500, especially if rates remain at this level. That's what I think. What do you think? Am I getting this wrong? Are you bullish on SCHD? Let me know in the comments and please leave a like if you enjoyed the video. Thanks for watching and I'll see you again in the next one.